Okay, let's begin. Good evening, everyone. At any time, if I'm not audible, please message or let us know, and we will check our connections. Welcome to this post-policy call. And I thought I'll probably take this in three parts. The first is, the cover the monetary policy today, and in what ways we think there is a bit of a tweak or change within the RBI with the coming of the new governor. Second is, global macro, because it is almost as, if not more important at this juncture, given what is happening in the US, etc. And third, then briefly cover the bond market, including where we think the biggest opportunities in the bond market are. So let me start with the RBI policy. As you would know, a much awaited rate cut was delivered today. So the repo rate was brought down to 6/4, which was pretty much expected by most in the market. However, market price action, you would think, is quite counterintuitive. Yields have risen today, which partly reflects some bit of disappointment that RBI did not follow through with more liquidity measures, and partly because a lot of people were just waiting to book profit today before re-entering later, which is a minor technical point. Our sense is there's a very short-term hiccup to the market. Now, while analyzing the RBI policy, the first thing one needs to think about is there some sort of a change with the coming of the new RBI governor? Remember, there is a risk that you overread, and some of the things that are happening may have happened any which ways. So you think about policy in three ways. One is the interest rate stance, which is in turn a function of the evolving growth versus inflation outlook. The second is there any refresh to the approach to regulatory measures? And third is on liquidity. Now, as far as the first of these is concerned, the new governor has basically said that the flexible inflation targeting approach gives enough flexibility to respond to growth versus inflation, depending upon evolving circumstances. Now, some in the market have probably tended to overread that he is not as serious with respect to the inflation targeting regime. We are not of that view at all. We think the earlier regime had also talked about flexibility in inflation targeting, and the context has changed significantly between when Governor Das remitted office and today. So to recap, till very recently, many in the marketplace, including RBI, used to think that 7+% growth rate, real GDP growth rate in India is virtually assured. But after the September GDP print of 5.4%, and the subsequent rebound, which is there but not as strong as one would have hoped, most people have now brought down their GDP forecast for this year in the vicinity of 6.5. Government is at 6.4. And for next year, similarly, between 6.5 plus minus 0.2, 0.3 basis points, or 20, 30 basis points. So clearly, versus what people were thinking earlier, growth is now weaker and therefore requires some bit of policy support. And second, and probably more importantly, the volatile elements of food prices have corrected very sharply, so that we are now talking about the January inflation print that comes in a week's time or earlier at roughly around 4.2 to 4.3%. And the RBI unveiled their average inflation expectation for the next financial year at 4.2%. So clearly the pathway is set for, or was set for, the first rate cut. And we believe, had it been the previous RBI governor regime, the rate cut would have been delivered. So we don't think there is any refresh or any change in the flexible inflation targeting approach, or the way the new governor is thinking about it. However, with respect to points 2 and 3, which is regulatory and liquidity, we do think there is a bit of a change. So you would recall that there have been some pieces of proposed regulatory changes wherein there has been a lot of discussion within the banking sector, where there have been views that should they be implemented in the way that the draft resolution has come, there could be further tightening with respect to lending conditions, with respect to the liquidity requirements that banks have to maintain, etc. So there are three specific pieces of regulation that have been talked about. One is the enhanced liquidity coverage ratio regime, which would have asked banks to provide for more government bonds or eligible bonds rather, for coverage on liquidity. Second is the capital loss or expected loss framework, which may have resulted in some enhancement of capital provisioning or so forth. And third is draft project finance guidelines. Part 2 and 3 are not clearly our domain, but what one heard is that had it been implemented as it was drafted or proposed, it would have led to significant tightening of credit conditions for project financing. Now, clearly, this governor is taking a more nuanced approach, and he seemed to have deferred implementation of these guidelines. So the expected loss guideline for indefinite and the LCR and the project finance guidelines have been deferred to at least 31st March 26. So clearly, he is, and he articulated that as well, that the cost versus, the mandate for stability is also being looked at. So there does seem to be, some shift, some letting loose as far as regulatory tightening is concerned. And remember, that also has a bearing on economic growth. However, I rush to clarify that there doesn't seem to be any letting down on the stability mandate. So within ensuring financial stability, they're trying to tweak basis market feedback, etc., how they want to implement these guidelines. The third and of very near-term interest to the market is the liquidity framework. And there we think there are substantial changes. So first of all, we've been talking about this since November, December, but just to recap, around October, what we track as core system liquidity was surplus 4.5 lakh crores. As of January, it was negative 70,000 crores. So more than 5 lakh crores of core liquidity got destroyed between December and January. And remember, or rather between October and January. And remember, in December, the RBI had also implemented a CRR cut that injected 1,16,000 crores. So despite the infusion of 1,16,000 crores through a CRR cut, we have seen a liquidity bleed from plus 4,50,000 to minus 70,000 crores between October and January. Now, we had seen in the earlier RBI regime some bit of hesitation in shoring up the system liquidity. But we have seen no such hesitation with the current RBI. And so far, proactive steps have been taken around this, including in our count now close to 1 lakh crores of executed and announced OMOs. So he has done, almost 38,000 crores of OMOs via screen so far. 20,000 crores of announced OMOs have already been executed. Another 40,000 are due. So close to 1 lakh crores of OMO purchases. Another 45-50,000 crores via FX swap, another 50,000 crores via 56-day VRR. And as the governor has assured today, these measures will continue going forward as well. There is one more change to the liquidity framework. So many would recall that in the earlier regime, the liquidity framework implemented was such that the 14-day variable rate tool was the dominant tool, and overnight liquidity was provided reasonably in a more constrained fashion on a need basis. For the current period, effectively, this regime has been done away with, and RBI is providing as much liquidity as the system needs, basis a daily VRR or variable rate repo. So in some sense, we are back to the earlier regime wherein you used to get overnight liquidity. However, instead of indefinite overnight liquidity, RBI is doing this basis market feedback. But it practically amounts to the same thing, because if market were to demand more, they will give more overnight liquidity. So here there has been a very important shift, at least for the time being. One is seeing RBI being much more proactive on liquidity. And second is, like I said, the earlier liquidity framework effectively has been junked for now. And you are back to provisioning overnight liquidity. Now, the important thing that this has done is that despite core liquidity having bled so fast, the numbers that I just gave, your overnight rate now is reasonably anchored at around the repo rate, give or take a bit. And that is courtesy availability of overnight VRR. And one hopes that if proactive liquidity measures continue, then permanent liquidity will also be assured. This is something that is assurance the governor has given today as well. Now, where did the monetary policy today fall short in our view and in the view of most of the market? See, the crying need today is provision of more liquidity. It's not so much the rate cut. So consider this, that even with the provision of liquidity that RBI has done and what I listed out, Our estimate is that by 31st March, what we term as core system liquidity would still be negative. And two of the reasons for that are that there is a seasonal rise in currency in circulation in this period. And between now and end of March, another 90,000 crores leaks out of the banking system into the hands of the public, which needs replenishment. And second is, although RBI's FX or dollar sales to defend the INR have reduced, but they have not been eliminated. And that one understands because there has been pressure. So that means that some bit of bleed of rupee liquidity from dollar sales can also still happen. So our sense is that there is still much more that RBI needs to do in order for market liquidity to become comfortable. And bear in mind also that once you have started to cut rates, now you need to ensure transmission via lower lending rates, and the channel is through lower deposit rates. And for you to be able to do that, you have to keep liquidity surplus. Now, this question was asked to the governor today as well in the press conference, because what he is committed to providing is, as much or adequate liquidity or words to that effect. However, the question asked was, does it mean surplus liquidity? And that's a question that at least we didn't think was answered directly. So market is still guessing on two things. One is how much is going to be the gap before the next set of measures are taken on liquidity, because clearly what has been done so far has been large, but not enough for the reasons and the numbers that I just explained. And second, what is the new stance on liquidity? Is it neutral liquidity? Is it surplus liquidity? Because remember, the entire rate hike cycle from effective rate of 3.35% to an effective rate of 6.5% was conducted in a period of very large surplus liquidity. Liquidity started to drain out of the system largely, from last year. So it's not as if, there is some conscious mandate that the RBI is adopting that liquidity needs to be kept neutral or things like that. And like I said, when you are cutting rates, it probably makes sense to keep liquidity in a surplus zone. Now, should the RBI move around to this point of view, which we think they would, then especially more, amount of permanent liquidity injection measures will have to be taken. So we think, more OMOs beyond the 90 or 1 lakh crores that have happened or are about to happen. Even after that, more OMOs may be required. Probably one or two more FX swap transactions, and maybe even more term VRRs. Also considering that if RBI is really about to pay something like 2,25,000 to 2,50,000 crores to dividend to government in May, then your liquidity problem is still till May. So you could also bridge this for a while by doing more term VRRs, so that you do term VRR starting now and ending in May or things like those. So long story short, and something which the governor indicated as well, they will continue to respond on both short-term liquidity and permanent liquidity measures. The disappointment, like I said, was that there is still a period of waiting that the market has, wherein they may think that they have done enough for now, but it's not enough. And the reason it's important is because this is what is known as peak busy season on credit. So every week, every 10 day, every 15 day that is lost is precious, because bank funding or bank liability side faces the maximum pressure during this period. So, because this is the busiest season amongst the busy season on credit. And therefore, this is the period when the banking system requires the most liquidity. So we are still hopeful that, more will be forthcoming. That's certainly the assurance from the governor. But there is definitely a significant change in the new RBI regime with respect to approach on liquidity. And, like I said before, dismantling effectively for now the earlier liquidity regime where 14-day was the dominant tool. That may be brought back sometime in the future when liquidity is adequately positive. We don't know. So that is, how we think the new governor is slightly different, largely on, the approach to the very conservative regulations. And second is somewhat on liquidity. On rate cuts, our view is that, so RBI is also exercising what we call constraint optimization. So clearly the stance has been kept neutral because the global environment is quite hawkish. Dollar rates are still high. Dollar index is still volatile. US Treasury yields are still volatile. And emerging markets are still under threat and actually experiencing of capital outflows. Now, in that environment, no emerging market central banker can choose to go too aggressive in monetary easing. And that is the constraint. The way the RBI is choosing to optimize that is keep stance neutral so that you keep future flexibility on your side. cut as much as you can, depending upon your growth inflation outlook, but also with a view to the currency, and provide enough liquidity. Now, if it were up to us, we would have rather said that, you do much more on liquidity and push the rate cut out to April. Nobody would have minded. But in the event, because probably it's the Monetary Policy Committee that decides on rates and RBI decides on liquidity, the MPC thought it's a prudent time to cut rates because inflation has fallen off and to back to 4.5%, and growth requires some support. And like I said, we do expect RBI will come through. So that basically is the monetary policy review today. And like with the government of India on the budget, as well as with RBI on this, it's an exercise of constraint optimization. And like I said, where is the constraint coming from? It is coming from the US exceptionalism trade, which is nothing but to say that US growth has kept on at a very strong pace. US assets have been doing quite well. And therefore, a lot of capital has been moving into the US. US rates are higher. So that is basically emerging market tightening. So one of the global questions, which brings me to the second section of what I want to talk about, is how long is the US exceptionalism going to last? Because remember, for emerging markets to feel some relief, dollar rates have to sustainably come off, volatility in that market has to come off, and capital flows have to resume. Now, starting when we think about the current global framework, the one thing you should keep in mind is that it's a very strange situation we are facing now and for the last few years, where so what used to happen earlier is that financial conditions around the world were determined by US because it prints the reserve currency of the world. And US used to grow between 1.5 to 2%, and inflation used to be around 1.5 to 2%. So US rates were very close to zero, and therefore global financial conditions were easy enough. Growth for the world used to come from emerging markets, largely led by China. So if you're a global asset allocator, the template was clear. You borrow, reasonably cheaply in US rates, and you can deploy in emerging markets where the growth is. However, the problem currently is that both global growth as well as global financial conditions are being driven by the US. So US is the best growing economy, given the context that it's a developed market and it's the highest GDP in the world. And because it's the strongest relative to its own previous history, rates in US are high, inflation is still reasonably sticky, and Fed rates are high, and dollar is strong. So this needs to break. So you can't have global growth as well as global financial conditions coming from the same geography, because if growth is high, then financial conditions by definition will be tight. And if financial conditions are loosening, it's because growth has fallen off, right? So the world has to settle for either continued tight financial conditions and US exceptionalism, or a period where US starts to downtrend, and therefore global GDP kind of corrects for a while, and therefore financial conditions loosen. So the point I'm making is this current format is inherently unstable, and that is levying a very large tax on emerging market easing, right? So, the path we think, like I said, is that US growth slows for a while. Therefore, financial conditions globally ease, dollar index corrects, interest rates there fall, capital flows restart to emerging markets, and then you have a more rebalanced global cycle that comes through. But for that, you will have a period of pain on global growth. Now, how are we thinking about US exceptionalism? Because this is something that now we've been thinking about more than 2 months or 3 months, especially since the so-called Trump trade came into fashion. So as we know, US completely reset their fiscal trajectory post-COVID. So they used to be a 3.5% fiscal deficit country. In 2 years of COVID, they went to 11 to 13% fiscal deficit. But very strangely, after COVID, even though they are growing so well, their fiscal trajectory is still stuck at around 6.5% of GDP, which is what typically an emerging market runs. So for example, in the case of India, if you were to add state plus center fiscal deficit, you will basically arrive at a number of 7.3, 7.4. US, being a developed market, is still running a fiscal deficit of 6.5% of GDP. So the first source of exceptionalism for the US is this, that it's really government that took on all the debt. Private sector was quite clean. It was deleveraged. It took on long-term liabilities, so the interest rate hikes did not really matter to them too much. Whatever operating surpluses they were generating, they were parking at 4.5%, 5% rates. And similarly for households who saw a very large cash transfer. Now, the fiscal stance in the US is still stuck at 6.5% of GDP, but importantly, there is no net new fiscal stimulus. So last year 6.5 and this year 6.5 basically gets you a hygiene level of growth, but you can't argue for growth acceleration on the back of it. Second source of American exceptionalism is basically that the private sector has been clean balance sheet wise, and it has actually embarked on a reasonable capex cycle. The private sector capex cycle in turn has two components. One is, or two triggers rather. One is deep tax cuts in the Trump 1.0 regime, where the effective corporate tax rate in the US was brought down to less than 20%, which obviously generated some animal spirits and some capex. And second is, US being the seat of the AI revolution, also being held by the CHIPS Act that Biden passed in 2022. So as a result, you are seeing a reasonable capex happening on AI and AI infrastructure, which includes, data centers, utility companies, and all of that. Now, there is a case to be made, although the AI related capex plans announced for next year are still very large, or this year and next year are still very large. But there's a case to be made that, especially with the advent of things like DeepSeek, etc., as well as investors not finding immediate return on these capex investments, some bit of this capex investment starts to fall through, which means that the run rate of private corporate capex cycle in the US starts to somewhat slow, which can also, on the margin, dent the US exceptionalism trade. The third reason, which is the most at risk, is that over the last 4 years, the US has seen massive immigration. So close to 2.5 to 3 million people per year have entered the workforce in the US, which has allowed non-inflationary growth, or rather growth without accompanying inflation, because both consumption demand as well as output rose. Now it's quite clear, and most of you would appreciate that, especially with the new Trump policies, which are quite anti-immigration, this incremental flow of labor is going to reverse. And therefore, what is associated with is weaker demand, because those many people are no longer part of the workforce, but also higher cost of production. So some people have started to worry about, especially given tariffs as well as such effects of some sort of a stagflationary effect, right? And if something like that were to happen, that will also dent the US exceptionalism trade. And one other reason is that it's a very, very, very overowned market now. So, we all know that equity market cap for the US as total world market cap is something like 70% or thereabouts. Even though the size of that GDP compared to world GDP is much lower, a lot of funds flow have happened into equity markets there. And therefore, the burden of proof is on that market to continue to perform in an exceptional fashion. So long story short, although a difficult trade to call, but we think you are probably on the brink of US exceptionalism, if not completely turning, at least stabilizing, which will allow easing of financial conditions around the world as well to some extent. And indeed, some bit of it we are seeing. So quite coincidental, the last time when Trump came, US dollar was rising all the way till Trump's inauguration and then started to weaken. Some similar format we have seen this time also. Let's see whether it continues. The other thing that works for the world is that other large geographies are actually actively easing rates. So look at ECB, European Central Bank, where the European growth prospects look quite horrible. Look at Bank of England, which is also easing. So a lot of other geographies are easing rates, which is to some extent balancing the US exceptionalism. But the fact of the matter is you need US to turn. So, that is basically the state of global macro to summarize. So we listed down some reasons why the exceptionalism trade exists. We talked about, how some of these reasons may be on the brink of turning, especially the migration, but also probably to some extent the capex cycle. But that is not as clear, admittedly, as of now. And some compensation is being offered by other countries easing interest rates. So I would term, the global environment right now as mixed. India's connection is not as strong with respect to trade flows, although it's strong enough as far as capital flows are concerned. So India can afford some bit of monetary easing, but not too much. And that is how you should also read the budget, that the government just does not have an option to show anything other than fiscal credibility. And therefore, it was very important for them to stick to 4.4 deficit, which the finance minister had committed earlier. and stick to the debt to GDP framework that they also had talked about earlier. So we're very happy that this macro policy combination is happening in India. Let me now turn to the third factor, which is where we think market opportunities are, and where we are positioned as per publicly disclosed portfolios as well. So the clearest way to look at market opportunities is think about the shape of the individual curves, which is corporate bond curve and GSEC curve. You can also add the SDL curve in between. Now, as we have talked about before, the corporate bond curve is still deeply inverted. So you're getting 1-year bank CDs at around 760, 765. The 10-year, 15-year point on the corporate bond curve is at 7.25. So there is a 40 basis point inversion between 1-year and 15-year on the corporate bond curve. Look at the government bond curve, where 1-year treasury bill today is around 650, 655, and 15-year government bond is around 680, 85. So the government bond curve is positive 30 basis point, and the corporate bond curve is negative 30 to 40 basis points. Right? So clearly, the biggest opportunity on the corporate bond curve is therefore at the front end, where the spreads are the highest and the yields are the highest, which is basically the 1-year, 2-year, maximum up to 3 years. But we would not touch the 10-year, 15-year on the corporate bond curve. And the maximum opportunity on the government bond curve is duration. That depends on your own criteria for how long you want to participate and how much volatility you want to digest. But we like everything on the government bond curve 10-year onwards. In our active duration funds, we continue to be very, very overweight 2053 government bonds, and we are very happy to continue to be overweight those. They have not minorly, significantly underperformed over the last 3 months as 10 to 30 spreads have widened. But we put out a recent communication as well as to why we think this will not sustain. So there is a temporary demand supply mismatch, which we expect to correct. The government of India is now borrowing average tenure of almost 21 years. It doesn't need to borrow this far out because if you see the maturity profile of government debt, most of maturities are happening over the next 9 years, after which the government has a clean slate and it can basically afford to borrow 10-year, 12-year, 15-year also, and doesn't necessarily have to borrow 36, 37% of total issuance in 30, 40, 50 year. I should also mention that today, the RBI formalized the bond forward guidelines. Now, what it does is large state-run insurance companies who were still not participating in the derivative market because the bond forward guidelines were not formalized are expected to now come in. Now, this creates additional demand for the long end of the curve. And therefore, we think that this recent widening of 10 to 30 spread that has happened should now stabilize. Also, bear in mind that if you are a real money player, which means that if you're a mutual fund investor or a mutual fund itself, what matters is the duration you're holding. So let's say there is a 25 basis point rally. The 30-year has to only perform by 15 basis points for the 10-year performing by 25 basis points for you to make equal or higher money in the 30-year. So as long as you are bullish duration, in our view, you have to hold long tenure bonds, but you have to have the investment horizon for that. Now, just to recap the government bond market scenario. So you already have RBI doing OMOs. Close to 1 lakh crores of OMOs would have happened by the end of February. We think more will happen. If you look at the next financial year, if the balance of payment does not turn heavily surplus, the RBI will have no choice but to continue OMOs in order to ensure positive liquidity, which will also create additional demand for government bonds. If the RBI stops, that means the global environment has turned conducive, in which case FPI flows will start more meaningfully. And therefore, the demand will come either from RBI or from FPIs. Fiscal stance for the government is very credible. So you can forecast the amount of bond supply you're getting next year, year after that, etc. And like we have been highlighting many, many times before, in India, FPI ownership is only 3% of total government bond outstanding. And there's a huge amount of increase that you can see from FPI participation over the next few years. So, in the very short term, we get sidetracked by a lot of factors which are moving. In our view, the only thing that matters today to execute a very strong bullish bond view is what is happening in the US. Should the US give you the green flag, India-specific factors are very, very strongly bond bullish. So you're getting monetary easing, you're getting liquidity support, you're getting OMO purchases, and you have a very credible fiscal framework. So think about where long end of the bond curve has been under pressure. So take developed market example. So it's been in US and in UK, both where fiscal is a problem, right? So macroeconomically, you don't want to buy the long end because you don't like the fiscal dynamics of the country. India is the opposite of that. So there's every reason to like duration in India. Let me turn now to the corporate bond curve, which I briefly said, up to 2 year, 3 year is what makes sense, because after which the curve is very deeply inverted. Now, remember, for performance of, let's say, 1 year bank CD, the RBI needs to show their hand better with respect to liquidity management for the rest of this financial year. However, once you enter April, May, June quarter, things will automatically start to sort themselves out. And the reasons are as follows. See, you already had one rate cut. In all probability, if not in April, then by June, you'll have another rate cut. So that's something to look forward to. Secondly, the busy season on credit transitions to lean season in the April-September half year. And given that you are in a period of credit slowdown, this year the lean season on credit may be exceptionally lean also, right? So that pressure that you're seeing on deposit rates and etc. will basically start to then come off. Thirdly, we discussed liquidity, but let me recap. In May, RBI will pay dividend to Government of India, which is likely to be in excess of 2 lakh crores. And from mid-May, currency in circulation also starts to reverse temporarily. So even if RBI from here is slightly muted in incremental steps, in all likelihood, from May onwards, you are back to a significantly positive liquidity scenario. So it makes imminent sense for investors to use this period of volatility to build a front-end book if that is what you are wanting to build. So in our view, probably the best trades are you build a front-end book, which is 1 year CD and around, maybe up to going up to 2 year, 3 year. But this segment will be prone to volatility in the near term. But like I said, the performance drivers really kicking in after April, and by duration via government bonds. The SDL curve sits somewhere in between. So it's positive sloping, but the duration dynamics are not as positive as the government bond curve. So the way we like the SDL curve is, up to 5 year, 7 year is good because when you buy 5 year, 7 year, it's a mix of, what you want in duration as well as you benefit from the additional carry you get. But when we are thinking about buying 10 year, 15 year, 30 year, we much prefer the government bond curve and not the SDL curve. So that's basically what I wanted to talk about. Let me just quickly summarize. So RBI delivered 25 basis points. No new measures on liquidity yet, which is minor market disappointment. We think the new governor is slightly different or approaching things slightly differently, not so much on rate cuts or the flexible inflation targeting format, but definitely more proactive on liquidity and understanding that the old liquidity framework needed to be junked for now. So provision of overnight liquidity that is anchoring the overnight rate. Thirdly, on regulation, he seems to be more open to market feedback and rolling forward implementation and diluting somewhat, which will be a relief to the banking sector. Coming to the international environment, the big driver is the US exceptionalism trade, but largely driven by immigration stalling, probably some stalling in capex cycle, and no incremental fresh fiscal stimulus, as well as the over ownership of that market. It's quite possible that the US exceptionalism trade stagnates this year, thereby relieving some pressure on emerging markets and allowing banks like RBI to ease monetary policy more aggressively. From a market standpoint, we like the front end of the corporate bond curve, including 1 year bank CDs. But the real trigger for their performance kicks in from the April to June quarter. The near performance is a function of whether RBI takes in more measures, which we think they will, but they will prone to be volatile. But we do think investors should be using this phase to build out that book. And we like duration largely via government bonds. We think the long duration government bonds are also very well poised, although they offer more volatility. And therefore, that's a subject of your risk appetite. In the SDL curve, we really like up to 5 year, 7 year, because beyond that, we think government bonds are a better duration story.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.